This video is intended for educational purposes only. It is intended to give investors an understanding of the fundamentals of doing tax-deferred exchanges under Section 1031 of the Internal Revenue Code. This video is not intended to create an attorney-client relationship. The information contained herein is believed to be accurate at the time this video was created. However, tax laws can and do change. Be sure to consult with both your attorney and your accountant before taking any action based on this video.
Hi, my name is Bruce Theobald. I'm a real estate agent, a real estate attorney, and an active real estate investor. In this video, we're going to look at the fundamentals of doing tax-deferred sales of real estate using Section 1031 of the Internal Revenue Code. One of the best ways to illustrate what a tax-deferred exchange using real estate is to illustrate what it's not. Let's say, for example, 20 years ago, you had $100,000 and you put it in the stock market. Today, and over the course of time, that $100,000 rose up to $1 million. If you sold that stock today for $1 million, you would have a very large capital gain, and you might owe, let's say, $250,000 in capital gains taxes, and there's no way to avoid that. By contrast, if you had used real estate instead, and 20 years ago you put your $100,000 in real estate, today it's worth $1 million, and you sold it. If you followed all of the requirements for a Section 1031 exchange and reinvested the proceeds in another piece of real estate, you could legally pay nothing in taxes, and that's awesome. See this book? This is the lawyer's desk reference on doing Section 1031 exchanges. It's over 1,000 pages long. But what it all boils down to is this. There's 8 big rules that everyone has to follow who's doing a 1031 exchange, and then there's a million small rules. I can't possibly cover all the small rules, but in this video, we're going to look at the 8 big rules. So let's get started.
Let's take a look at the 4 professionals you will need on your team if you're going to do a 1031 exchange. The first person on your team will likely be a real estate agent. If you need help to sell your old property or help to find your new property, these are tasks that your real estate agent can help you with. The second professional on your team will be your attorney. If you're in an area such as the Chicago metropolitan area, where it is common for attorneys to represent buyers and sellers in real estate transactions, you'll need an attorney to represent you to handle all the details from contract to closing on both your sale transaction and your buy transaction. The third professional on your team will be your accountant or tax preparer. Many tax-related questions and compliance with 1031 are best handled by your accountant, since he or she is the person who will have to sign your return. The final person on your team is the qualified intermediary. The qualified intermediary is the person who will be acting as a trustee or escrow agent to hold the funds from the sale of your old property until you are ready to close on the purchase of your new property. Let's take a look at the first of 8 rules you must comply with if you're doing a 1031 exchange. The first rule is that you cannot touch the money from the sale of your old property while you are waiting to buy your new property. The IRS calls this the rule against constructive receipt. I'll just call this the no-touchy rule, although you will certainly never find that term in the tax code. But if you're not supposed to touch the money from the sale of your old property, how are you supposed to get the money from the title company that handled the sale of your old property to the title company that will handle the purchase of your new property? And the answer is the qualified intermediary. As mentioned before, the qualified intermediary is the person who will be acting as a trustee or escrow agent to hold the funds from the sale of your old property until you're ready to close on the purchase of your new property. By using a qualified intermediary, you can avoid coming into constructive receipt of the funds and therefore violating the no-touchy rule. This leads to the next question, which is who could be your qualified intermediary? The short answer to this question is that almost anyone can be your qualified intermediary as long as you do not have some type of business relationship with them or they are related to you. There is no regulation of qualified intermediaries, at least at the federal level, and currently only about 8 states have regulation at the state level. But the better question is, who should be your qualified intermediary? It is unfortunate but true that during the Great Recession, a couple of qualified intermediaries wound up filing for bankruptcy, and some investors lost money. The good news is that most of the major title companies have affiliated companies that specialize in acting as qualified intermediaries. That is where I would start if you wanted to compare one qualified intermediary to another. Above all, your first consideration when selecting a qualified intermediary should be financial stability and not price. Let's move on to rule number 2, which is the like-kind requirement. The IRS requires that properties exchanged in a 1031 transaction be of like kind. The good news is that this definition is very broad. You could, for example, exchange a house for a condo or a condo for a house. You could exchange a condo in the city for a farm in the country, or an apartment building for a shopping center, or vice versa. You get the general idea. One exception to the like-kind requirement is property held as inventory in a trade or business. This would generally include vacant lots held for sale by a developer or condos held for sale by a condo converter. Another exception would be your personal residence or your vacation home. Note that I said your. Let's be clear, there are no problems with single-family homes or condos or vacation properties as long as they are not yours. Other special rules apply to the sale of your personal residence, namely Section 121 of the Internal Revenue Code. A discussion of Section 121 is beyond the scope of this video. If you'd like more information about that, please consult with your accountant. Rule number 3 is the related party rule. Generally speaking, most arm's length transactions between unrelated parties are okay. But who is a related party? The rules on related parties can be a little bit complicated, but if the other party in your transaction is either a blood relative or someone you have had a prior business relationship with, you should check with your qualified intermediary and your accountant to see if that is going to be a problem. Shortly, we'll be discussing what is known as the 45-day rule and the 180-day rule. It is important to note that the IRS generally requires strict compliance with these and other time-based rules. There are 2 exceptions to the rule of strict compliance on time limits, but you probably won't qualify. The first is if you are in the United States military and serving in a combat zone. The second is if there is some type of connection between you and your property and a federally declared disaster area. For more details on those exceptions, please consult with your accountant or qualified intermediary. The 45-day rule says that you must notify your qualified intermediary of which properties you intend to purchase. If you make that notification before the 45th day after the closing on the sale of your old property, you can change it any time up until the 45th day. But after the 45th day, your declaration becomes irrevocable. And what happens if you don't purchase one of the properties you specified to your qualified intermediary in compliance with the 45-day rule? The answer is you no longer qualify for tax deferral benefits under Section 1031, and the sales proceeds from the sale of your old property are now taxable. Rule number 6 is the 3-property rule. The 3-property rule says that when you make your declaration of what properties you intend to purchase in compliance with the 45-day rule, you are generally limited to a total of 3 properties. There are some narrow exceptions to the 3-property rules. I'm not going to go into them into detail here, but if you'd like to know more, ask your qualified intermediary to explain the 200% rule and the 95% rule. Rule number 7 is the 180-day rule. The The 180-day rule says that you must close on the new property within 180 days of the closing on the sale of your old property. And note that 180 days is 180 days and not 6 months. Further, if the 180th day is a Saturday, Sunday, or federal holiday, you do not get an extension until the next business day. So 180 days really means 180 days. Rule number 8 is the up and up rule. So here's another phrase that you'll find nowhere in the tax code. I call it the up and up rule, which stands for the requirement that you have to go equal or up in price and equal or up in equity in order to qualify for a full tax deferral under Section 1031. Let's take a look at some frequently asked questions regarding 1031 exchanges. What happens if I blow the deadline for either the 45-day rule or the 180-day rule? The answer is disqualification. Your transaction will not qualify for a tax deferral under Section 1031, and the gain on the sale of your old property will now be taxable. Question number 2, can I buy first and sell later? Yes, you can, and this is known as a reverse exchange. In a normal or forward exchange, you sell the old property first and then you buy the new property. In a reverse exchange, you do the opposite, namely, you buy the new property first, then you sell the old property. This can be tricky and presents a practical problem of where you're going to get the money to buy the new property. But if you can get past that hurdle, the reverse exchange is definitely possible. A reverse exchange is both more complicated and more expensive than a forward exchange. For more information, talk with your qualified intermediary. Question 3. Can I sell one property and buy multiple properties? The short answer is yes, you can. You can sell one property and buy multiple properties. You can also sell multiple properties and consolidate everything into one property. Finally, you can sell multiple properties and buy multiple properties. Naturally, the more properties you have involved in a 1031 exchange, the more complex the transaction becomes. But if you can put all the pieces of the puzzle into place, it most definitely can be done. Question 4. Can I close on my sale and close on my purchase both on the same day? Yes, you can, and your qualified intermediary will love you for it. Question 5. What if I sell one property, buy another property, but fail to roll over all the money? Here's an example. Suppose you sell for $200,000, but your buy is only $180,000. What happens to the $20,000 surplus? The answer is it is taxable as boot. Boot is just a technical term that means surplus cash that you failed to reinvest and receive back. Question 6. Can I sell an old property, buy a new property, and then convert the new property to a personal residence? Yes, you can, but it's tricky. Be sure to consult with your accountant. First, you'll have to hold the new property for 2 years to satisfy the rules of 1031. After that, you'll have to live in the property for 2 of the next 5 years before you can sell it as a personal residence. Again, be sure to consult with your accountant on that one. Question 7. Can I change qualified intermediaries in the middle of an exchange? And the answer is no. I think the reason behind this rule is that the IRS feels that the rule is necessary to prevent fraudulent conduct. For example, the taxpayer might ask the qualified intermediary to do something. The qualified intermediary says no. So the rule is in place to prevent the taxpayer from saying, "Do what I tell you to do or you're fired." Question 8. Can I use my 1031 sales proceeds to pay for my rehab costs in addition to my acquisition costs? Yes, you can, and it's called the delayed improvement exchange. As an example, let's say you sold your old property for $500,000 and bought your new property for only $400,000. You have $100,000 left over. The new property needs work. Can the $100,000 surplus be rolled over to pay for the rehab costs on the new property? The short answer is yes. It's a little bit more complicated and expensive than a regular forward exchange, but it definitely can be done. For more information, please contact your qualified intermediary. Question 9. What is the required holding period for the new property? The short answer is that there isn't one, at least not in the tax code. However, if this is a concern, tell your accountant to take a look at Private Letter Ruling number 8429039 from 1984. This private letter ruling suggests that 2 years would be a good minimum holding period. Let's take a look at the future of 1031 exchanges. There's an old saying that no man is safe while the legislature is in session, and that certainly applies to 1031 exchanges. It is truly unfortunate that 1031 exchanges have come under attack as Congress looks to raise more tax revenue, especially when you consider all the positive benefits that 1031 exchanges provide to the real estate market. At the time this video is produced, 1031 exchanges seem to have been spared from the budget acts, at least for now. But laws can and do change, so it's important to keep an eye on Washington to see what might happen next.
Okay, so there you have it. Those are the fundamentals of doing Section 1031 exchanges. If you're thinking about buying or selling income-producing real estate in the Chicago area, please give me a call, because that's what I do. If you've enjoyed this video and you're watching it on Facebook, please be sure to click share. And if you're watching this video on YouTube and you'd like to be alerted when new videos like this become available, please click the red subscribe button. Thanks so much for watching.